Hi everyone. Hi everyone. I've been a quant trader, so just to give a brief introduction of myself, I've been. It's recorded, right?
Yes.
Okay.
Just flip on.
Okay. So just to give a brief introduction of myself, I've been quant trader for almost 7 months at Vincent. And I'll also tell you what Vincent does briefly. So we are focusing mainly on cryptocurrencies and financial derivatives which are related to crypto. And two of our revenue streams are market making. So we provide liquidity on cryptocurrencies on major exchanges. And the second revenue stream is over-the-counter trading. So over-the-counter trading is, in short, someone wants to trade lots of BTC, and they will have two options. Either they can trade it directly on Binance or another exchange, and the impact on the market will be high, or they can do it more cheaply, go to us, because we can execute that trade more efficiently. So that's in short about Vincent. But today, I'm going to talk about, introduction to market microstructure. So let's go through a very simple example. So imagine you're a tourist in Split, it's 2015, and you need Croatian kuna. So what are the options? You have euros and you want to exchange euros for Croatian kunas. And you have two options. Either you can stand in the crowd and ask someone if they have Croatian kunas because you want to exchange euros. That transaction has some risks. For example, the counterparty offers you fake banknotes. So you want to do something less risky. And you want to use so-called foreign exchange stand. So what it means, it sounds, at first it may sound complicated, but in essence, what it is that you provide offers. So imagine that if you need Croatian kunas and you want to sell euros, then you can provide this offer. So you will sell 1,000 euro for 8,000 Croatian kunas. Meanwhile, if you want to get euros for Croatian kunas, you can provide this price. So it seems like a good business model. So imagine that you're able to repeat those transactions, infinitely. Then you can make quite a lot of money, right? Because you'll be buying 1,000 euro for 7,000 Croatian kunas, and you'll be selling 1,000 euros for 8,000 Croatian kunas. So it seems quite, easy. But obviously, it is not, as this is like one of the most competitive businesses in the world. So one of the risks is that the price is moving against you. So imagine that on this market, you're market making on euro to Croatian kuna. So basically, you're buying one currency, selling one currency, and you offer transactions in both currencies. So, for example, if someone buys from you 1,000 euros, meaning that you're selling this 1,000 euros, then one of the risks is that 1,000 euros will be worth more than 8,000 Croatian kunas, in which case you lose. So that's one of the risks that you need to keep in mind. So what do you need to do with, in order to provide good offers for buying euros or selling euros for Croatian kunas? Well, the first thing you need to come up with is fair price. And you can think of fair price as something that you can, on average, always makes money by buying below fair price and selling above fair price. So that's basically the intuition. on very competitive markets, you can think of fair price as the mid price because the market is already extremely efficient. But if some cryptocurrency market is not as efficient as it could be, then your fair price could be your advantage. So you could make actually some money on having a better price compared to other competitors. So, yeah, so basically, this is a very dumb order book. Who is familiar with the term order book? Okay, so the order book is, we'll go through that. So basically, this is a very, very simple order book. So in the order book, you provide offers to buy something and offers to sell something. So yeah, as I said, in this example, you have some offer to, like you're offering people that you can buy from them euros, meaning that they're willing to sell euros for Croatian kunas, or the other way around. So if someone wants to buy euros from you, then you will be selling euros. So that's like the maker and taker perspective. So here this is a maker perspective, either you're buying or selling euros. Okay. Yeah, another thing is that, as I said, a very naive way of coming with a fair price is using current mid price. And current mid price is, let's say, current price you see maybe on some exchanges. So if you see like some conversion rate or whatever, you can think of that as the mid price. So that's basically price, in the middle. But on most competitive, like on more competitive markets, you need, or maybe less competitive markets, you need to come up with some fair price. So in that case, what are the factors that contribute to euro to Croatian kuna? Well, in the past, what were the factors that contributed to euro to Croatian kuna rate? So, it's monetary politics, it's maybe European Union changing interest rates, maybe it's Croatia changing interest rates, and everything affects this fair price. And obviously there are like many more factors, like you can imagine that maybe like last two biggest trades can somehow predict the future rate of euro to Croatian kuna. Well, I don't know. But certainly there are some factors in which you can try to predict the future price, the future fair price of the rate between euros and Croatian kunas. Yeah, and our job, like me as a quant, is to provide a good estimate of the fair price. It does not have to be always right, but it's key to provide that price to be good on average, so that on average you can make some money out of providing the good estimate. Okay, I think that we covered that. So as I said, previously you saw a very simple order book. Now this order book is a bit more complex because you have two more quotes. So each offer is a quote, so now what happened? So that was like a good business model, to buy euros for 7,000 Croatian kuna and sell euros for 8,000 Croatian kuna, and you were making plenty of money. But suddenly a competitor entered the market, and competitor is willing to buy 5,000 euros for 3,650 Croatian kunas. So in essence, what does it mean is that the competitor is willing to buy euros for more kunas. So if you multiply it like times 2, then it will turn out that the competitor is willing to buy 1,000 euros for 7,300 Croatian kunas. So this is from maker perspective. And from the taker perspective, meaning that someone wants to actively interact with the exchange, someone wants to, let's say, take that offer and And yeah, then someone for 1,000 euro will receive 700 and 300 Croatian kunas, or if you know, provided that that person executes that order twice. So this is a better price. And likewise, the competitor also provided an option to sell 5,000 euros for less Croatian kunas. So another competitor entered, and you know, if price doesn't change much, then that drives the spread lower. So the difference between, let's say, best ask, this is like best offer, best ask for selling, and this is best offer for buying. So yeah, so basically that drives the competition more and more, and competitors will be providing better prices to buy and better prices for to sell Croatian kunas. Is it clear for you? Or if you have any questions, you can always raise your hand. If I'm going too fast, then also let me know. Okay, but so far it's clear for everyone? Okay. Okay, so yeah, so I give you a brief overview of of the Orderbook. That was like extremely dummy Orderbook because that consisted of 4 offers. So we have like 2 quotes, meaning those bars on the left side, and 2 quotes on the bar side, on the right side. So in practice, there are many market makers, and those market makers, provide like plenty of offers. So they will be willing to trade small amount of money close to the mid price or fair price, and maybe larger amounts farther from the mid price or fair price, and it's actually more complicated. So basically, you can do a trade in 2 ways in the Orderbook. So either you can provide an offer to the Orderbook, so you can say that I'm willing to trade X amount of euros for Y amount of Croatian kunas, or you can take one of the offers. Do you see the difference? Okay, that's good. And an interesting thing is that there was, when you have a sequence of those trades, so many people are taking the offers back and forth. One interesting phenomenon is that there were 2 types of flow. So there was a random flow that you want to catch, and there was toxic flow that you want to avoid. So what's the difference? So for example, a toxic trade knows something more than you, and you want to avoid being traded against those people. So in the simplest scenario, you can imagine that let's say someone actively watches interest rate changes, and even someone is at the in Belgium in the European Union building, and sees if EU increases the interest rates or decreases, and based on that, someone makes trades. And let's say we are kind of slow to update prices because we retrieve the prices from the internet. And let's say interest rates of euros go down. Then this is any information for the person who actively watches the interest rate changes, and is able to trade against you, meaning that one person will take one order, let's say our order, and after that, the price moves against us. So this is the very simple example of toxic flow that you want to avoid. And on the other hand, you want to catch, as much random flow as possible because this is the easiest money. So this is a more complex example of Orderbook. So on the left side, you can see bits. So as I mentioned, these are offers to buy some asset for some price. On the left side, on the right side, you've got offers to buy some amount of assets for some price. Do you have any questions regarding this picture? Okay, I'll just mention that we have like MM1, MM2, MM3, we have MM3, and MM refers to market maker. So market makers provide offers to buy or to sell. So one thing regarding like the good and the bad guys is that the mass in the order book is called liquidity. So what you saw on the previous picture, this is liquidity, and there are various measures of liquidity. A very simple measure is that you can take you can sum all the offers on the asks, you can sum all the offers on the bids, and you will have a measure of how liquid the bid side is and how liquid the ask side is. So in short terms, the better the liquidity, the cheaper for takers it is to trade a certain amount of money. So if liquidity is pretty high, you can cheaply, let's say, buy lots of some equity. Let's say it's Bitcoin. So you can buy lots of BTC cheaply. However, if this first pile was much lower and you wanted to buy lots of Bitcoin, then you would actually need to go to, let's say, that price. So instead of buying Bitcoin for like 10,000, you would buy Bitcoin for 10,005. And in HFT, the exact price you're trading matters a lot, because if you can buy for 1,000, not for for 10,000, not for 10,005, then you make some micro percentage, or you save actually some micro percentage on that trade, and it matters. Okay, so I will cover the brief definition of the the good and the bad guys. So the good guys provide liquidity, and the short answer why they're good is that they provide more competitive prices. So other people are able to trade certain currency, equity or commodity at a better price. So in the case of euros to Croatian kuna, initially I provided an offer to sell 1,000 euros for 7,000 Croatian kunas, but if someone provides a more competitive quote, let's say, or an offer, then someone might provide I will basically buy 1,000 euros for 7,499 kunas, and that guy makes a tiny amount of euros or kuna on average by trading. And if the market is healthy, there is no lots of manipulation, then it's pretty competitive, and you're able to execute those trades pretty decently. Okay, I think now we can go to some fundamentals of Orderbook. So I'll basically be speaking in a more technical language. So first thing, there are two order types in which you can interact with an order book or market. So the first type is a limit order, and in the limit order, you specify quantity of the asset that you want to buy or sell, and the maximum or minimum price that you want to trade or offer opportunity for others to trade with you. So in limit order, you can either be a market maker or a taker, meaning that you're taking someone's offer. So if you provide, let's say you want to buy some Bitcoin. So in the limit order, you can specify maximum price that you're willing to buy to be less than the current mid price. So in that way, your offer will stand in the order book. Meanwhile, if you provide a maximum price to be above current mid price, then you're likely to take some of the selling offers. I'll go through an example on the next slide. Yes. And after you took some amount of BTC, you will put your quote to buy, but that will be a passive quote. And the small difference is fees, because market makers are typically offered even like negative fees, so they're paid to market make. Meanwhile, takers pay higher fees. And this fee ranges from like 0.01%, maybe sometimes lower, maybe higher. And market makers, on the other hand, have, at least on cryptocurrencies, often negative fees. So by providing opportunity to trade with some other people, you're paid for that. Okay, and here is also like in the second point, you can see like Orderbook structure. So as I mentioned, you have like the bid side, the ask side. So these are like standing buy limit orders and standing sell limit orders. So that was covered. Maybe I'll show the like points C and D on the picture. I think that'll be the easiest. So so you have like the bids, offers to buy, offers to sell. And from some technical language, like this is the best bid, and this is the best bid because that market maker provides the best price for takers. So so basically this is like the best price currently offered in this market. And the best offer, also called best ask, is an order to this is like a limit order that offers to sell some asset at the best possible price. So often you can find some interesting patterns in the differences between best ask and best bids. So if you're participating in the competition, then you can look at what's happening on the best bid and best ask, because that can provide you lots of useful information. Okay, so now we'll cover a couple of metrics that I don't know the exact rules of the competition. Maybe there will be Orderbook, and if there is some Orderbook, I think those metrics could be useful to track, or maybe to find some patterns so that you can maybe predict price better on the competition, or like provide better pricing based on your model. So so the first thing is the mid price. I think this is obvious. So we have like the best possible ask price, the best possible bid price, and we take average of those two. So in this example, the mid price will be precisely here, whereas the black vertical line. However, if the best bid was taken and this client one wouldn't provide back the same quote, then the best bid would be at price like 3, 9, and 6. So the mid price would actually move somewhere here. Okay. The second metric is weighted mid price. So this basically weighted mid price tells you where is like more like what side is basically has like this higher bar. So like on it's either like on the best bid or on the best ask, we provide a higher amount to trade. And this weighted mid price is actually useful. It's actually some signal, but the signal is so weak that you can't really make money of that because of fees. So so this is like just one thing. And the weighted mid price is weighted by the amount of quantity that you're willing to buy, or the quantity that you're willing to sell. So in that case, the weighted mid price will be shifted a bit to the right, and this is because people are willing to sell a lot at 10,000 rather than willing to buy at like this price, like 9,999. Okay, so this is, okay, and last one thing is the tick size. So I think it won't be much useful like during this competition because the tick size is very specific to the market. So maybe if there are like, multiple markets on the competition with different tick sizes, then that could, the knowledge of the tick size can make a slight difference in the results overall. So a tick size is a minimum gap between two consecutive orders. So, for example, in that case, the tick size is 1, and this is because you can't provide a quote, let's say at price 10,000 and 3.5. So, so basically you can like provide on, like price on whole numbers, and you can't do really much about it. But you can take that information to your advantage. Okay, yep, question?
Could you maybe give an example of how we would use the tick size?
How would you do? Use it, okay. So, yeah, so for example, imagine that a tick size is in 1 basis point, and 1 basis point, like 10,000 basis points is 100%. So this is like 0.01%. So this tick size is very small, and you're very uncertain about your fair price. So on a market with small tick size, you will likely not, well, especially if you're uncertain about your fair price, you won't provide, best offer, best ask, and best bid, let's say, with a spread of tick size, because you can often get adversely selected. So someone with a better fair price could take your offers and make money on it. Meanwhile, if a tick size is large, let's say the tick size is 0.5%, there are some markets on cryptocurrencies with tick sizes of 0.5%, then I think it would be like pretty safe, of course, it depends on everything else, but you can safely try quoting, like providing offers to buy and sell on the best bid and best ask. Because if tick size is 0.5%, then your fair price needs to be, like at least 0.5% wrong in order so that you lose money. Do you see the difference?
I do, but I would assume that the tick size is related to how well you can predict the fair price, right? It's difficult to predict the fair price. Mm-hmm. I would assume that the tick size is rather large, and if it's rather easy, it's rather stable, then the tick size would be smaller. So we kind of assume it's already, in some sense, right, like part of the market.
Yeah, it's kind of intuition. It's a good intuition. But like on some markets, there are like multiple exchanges. So like on cryptocurrencies, the two most famous exchanges are like Binance and Bybit. And on Binance, tick size can be small because Binance like updates this tick sizes very often, and they don't want tick sizes to be large. But let's say Bybit, which is like second most popular cryptocurrency exchange, updates those tick sizes very infrequently. So in that sense, in that scenario, you have a good fair price because of Binance, because of exchange A, and you can relate that fair price to, let's say, exchange B. So it depends. But if you have one market, then I would say I would agree with you. Okay. Yeah, let's maybe cover last 3 technical metrics that come from Orderbook or trades, and this is the spread. The spread is the difference between best ask price and the best bid price. So if the market is extremely competitive, then the spread almost always equals to the tick size, and the tick size is the minimum gap between 2 consecutive orders. So that's it. So two last metrics is the depth of the trade and slippage. So these are the 2 metrics that you want to keep track of when you execute a trade actively. So you're not a market maker, but let's say you have a better fair price model, and you want to take some of the standing orders. So the depth of the trade is the difference between maximum fill price and minimum fill price. So maybe let's have a look at an example. So let's say we executed some take limit order, and we're taking everything, we're buying everything from price 10,000 to 10,005 because we believe that the fair price is 10,007. So the depth of the trade would be the difference. That would be like 10,005 negative 10,000. So we moved by 0.05% basically. And the slippage, which is, I'll show you the definition once again. So this slippage is the average fill price negative first price. So the first price is actually like the minimum fill price. So that's the lowest price that you take the order. So on that picture, like you're buying for 10,000 as this is the lowest price, and you're buying for 10,005, which is the maximum price. And if you take, weighted average according to the quantity bought at certain price levels, then you will get the average, average buying price. And if you subtract the lowest price, then you will get the slippage, which says roughly, how badly you traded on average. Because the greater the slippage, then you paid more to execute that trade. So basically, if your slippage would be, I don't know, like 0, then you essentially didn't buy for anything more than 10,000. However, on the other hand, if your slippage is really high, then it means that you paid a lot to get certain amount of Bitcoin, Ethereum, or any other currency. Yep.
But isn't depth more important when making large trades? Because then there isn't enough offers to fill it on the lower side, so you have to go higher.
Yeah, this is. I personally agree with you, but actually, what you care about mostly when you do a large trade is the slippage. So if you want to, let's say, so in that case, if you really want to buy, let's say, in this limit order there is, I don't know, like 10 Bitcoin in total. So if you want to really get 10 Bitcoin, then what you would care about is actually the slippage, because that will be the average. Slippage would tell you how expensively you bought 10 Bitcoin. And imagine that you wanted to buy 10 Bitcoin, and let's say on the best ask there is 9.9 Bitcoin, and there are some leftovers here, right? So the slippage will be actually very small. However, depth will be high. Because you really wanted to get that 10 Bitcoin, not 9.9 Bitcoin. And to get that 10th Bitcoin, you actually wanted to take everything. But overall, according to the slippage metric, your average fill price will be actually pretty small. Do you see it?
So slippage is just weighted average.
Yeah, weighted average, yeah. Slippage can be also measured in percentage, and that will be the average fill price, subtracted, the first price, and we divide by then we divide everything by first price, and we're given slippage in percentage. Yep.
If we are very against slippage, we can just use limit orders, right? Or
if you what?
If you want to avoid slippage, just use limit orders. Is it like that?
Yeah, precisely.
I understand it correctly.
Precisely. I also mentioned, maybe I will mention once again about the limit orders and market orders, because I'm afraid I did not cover the definition. So that's what you described is the limit order. However, you can also execute your order with a market order. And yeah, in the limit order, basically you specify the quantity and the maximum price that you're willing to buy, let's say, for the sake of example that we're buying. And yeah, so this is the limit order, so you specify the maximum price that you're willing to buy for. However, if you don't care about the price at all, I don't know, like whatever the reasons, maybe the order will be processed by the exchange faster. But you can buy something with a market order. And in the market order, what you care about is the quantity, and obviously it's at the site. So in the market order, you specify that you want to buy 10 Bitcoin, but you don't care about, like the slippage or whatever the price is. So, in extreme cases, you can like wipe out, all the asks, and you will pay quite a lot in percentage for that trade. But on the other hand, what you can do like more efficiently, you can like take the first order, like the first like everything at at price 10,000, and let's say wait a bit, maybe someone will show up with the same offer once again. That could be a bit cheaper. Okay. Okay, this is actually, I think, weighted mid price here is a mistake because this golden arrow should point to like more to the right because there is more weight on the ask side rather than on bid side. But yeah, I think we covered everything. Do you have any questions related? Yeah.
So in that graphic, you can like see by which market maker the different orders are. Is that also true in real life, in crypto?
Not in crypto. In crypto, you don't know who is providing the offers. That will be extremely beneficial because in like non-cryptocurrency markets, so for example on commodities markets or foreign exchange markets, you know who is provide certain prices. And if you see someone, like quoting, let's say like client 1 and client 2 is the same person, and you're actually able to identify that client 1, like this is like clients, like this is like the same, let's say, person, and they provided one offer to buy here and offer to sell over there. Then what you can see is you can maybe retrieve some fair price of the competitor. So maybe the fair price, your fair price is actually wrong, and maybe it should be somewhere here. This is extremely useful information, but in cryptocurrency, you have this additional challenge because you don't know who is doing what. Yeah. Okay. And lastly, I wanted to talk about like 3 ways to make a living in this business. So basically, how to thrive as HFT. So first, most important thing is actually to be smarter. Second one is to be first, and third is basically cheat, but this is called market manipulation. And you want to avoid that because you can be convicted for market manipulation. Some HFTs are, extremely rich, and they settle like large fines with U.S. government, to keep, doing the business. So I don't know, like a couple of companies paid like 100 million to U.S. government, so that like the market manipulation is cancelled, and they continue making money using more legal ways. But yeah, be smarter. Like, what's it all about? So first thing, maybe you can, execute an arbitrage. And an arbitrage is a concept in which you can make money instantly. From the mathematical perspective, arbitrage means that there is 0 chance that you will make a loss, but there is some probability that you will make a profit. So if you compute expected value of that, then the expected value is actually positive. Yeah, so someone wants to buy something for 20K on exchange, B, someone wants to sell for 10K. So you're buying from the person who wants to sell for 10,000, and you're selling to the person who wants to buy for 20,000. And well, in that sense, you make 100% on that arbitrage, which is very unlikely in real life. Okay. second example. So this is actually a financial derivative called a perpetual, which is closely related to futures. So in futures, you enter, like in simple terms, you agree on the price that you will trade some asset in the future. So yeah, so this is like a future. Perpetual is a bit different. So perpetuals never expire. So you basically enter the contract and enter the position in like this perpetual. And the key thing about perpetuals on cryptocurrencies is that if the price of the perpetual is below the index price or price of the asset, then those who are long, those who are buying, are paid the difference. And similar thing happens when price is above the asset's price. So so here, if you're long and price is above let's say I don't know, like Bitcoin's price, then you're paying. So basically, you have like a Bitcoin, and then you have like a perpetual, and these are like two separate things. But price of perpetuals is heavily correlated with Bitcoin's price. What are advantages? Because I think that's a valid question. What are advantages of perpetuals? So like financial derivatives are often much more liquid. So if you know that Bitcoin will go up by 1%, in the next day, and you're certain about it, then you can execute the trade by entering perpetuals, because financial like this futures markets and perpetuals markets are much more liquid. So instead of like you're 100% certain about this 1% increase, you want to gain exposure to 1 billion Bitcoin. So if you were to buy 1 billion Bitcoin on the classic market, meaning that you will actually buy the coin, the digital coin, you will pay quite a lot to enter such a position. Meanwhile, if you will buy everything through perpetuals market, which is much more liquid, you will pay much less to get to that exposure. And ultimately, after the Bitcoin increases by 1%, you will be also able to close the position much cheaper because of this enhanced liquidity. And what I mean by this enhanced liquidity, so you can imagine that as this a very simple example of some, I don't know, let's say it's Bitcoin market. However, the perpetuals market will be much more dense, and people would be willing to trade larger sums of that quantity. So that's a notch regarding the complex financial derivatives. Second thing, as we operate in high frequency, speed also matters. So imagine that someone bought lots of BTC in exchange A, and there are exchanges B and C. Let's say those exchanges are located, in China and maybe in Croatia. So what you need to do is that once you see this information about the trade, so someone is buying a lot of Bitcoin. So what does this mean is that price will probably go up. So now what you want to do is you want to use that information. Okay, so it's Hong Kong, whatever. So now you want to use that information to update your prices in exchange B. So for example, if you were offering to sell Bitcoin at a very competitive price, having seen the price increase on one exchange maybe can force you, to remove that offer. That could be pretty valid. And lastly, I'll talk about two challenges. I think maybe conceptually it will be more intuitive and less technical. Let's go through the risk or reward. So imagine that fair price is somewhere here, and you have an offer to sell over there. So the thing with this quote is, let's say this market is extremely competitive, and actually on the best bid and the best ask, you have like lots of sums, and you're not able to catch volume like trades with your quote. So probability of getting filled is extremely small, but once you get filled, your reward can be pretty high. On the other hand, if you provide price on the best ask, then you will catch lots of volume, but your reward will be pretty small. So that's, of course, like assuming that fair price is constant. So yeah, like also one thing regarding the risks. So in this scenario, if fair price and actual price, let's say, moves to the right, then what can happen? Well, you will get adversely selected, and so someone with, I don't know, like with better speech or with better information will be actually able to trade against you and take that quote. And like in a very short time frame, you would see that you made a loss, and those who, like the guy who took your quote, made some money. So this is a risk that you're exposing to. So in that particular example, the risk is that your fair price is wrong. But if on average fair price is always good, or like on average is good, then on average you should make money. And in HFT, we mostly care about expected value of certain trades. Okay, and last thing, reliability. So computers typically don't make mistakes, but human make lots of mistakes, and because of that, human can make a change in an algorithm or in something that can cause huge losses. I'm going to tell you a bit, shortly, a story about Knight Capital. So Knight Capital was a super large HFT company which went bankrupt a couple of years ago. And one of the software engineers uploaded wrong version of the code. And basically, the code that was like a testing code, and what they wanted to test is that it was like some taking algorithm. So basically, they didn't care about market making, but they were taking some bids, some asks in a certain way, and the testing algorithm was wrong because what they were doing is they were like taking one bid, then one ask, and they were taking both sides all the time, and that means that if you're taking and price doesn't move, then you're losing firstly because of the spread, and because of the spread, market makers make money, and secondly because of the fees. So because of the fees, they were actually like losing tons of money. And in 35 minutes, they lost 440 million because of one stupid mistake. So summing it up, in order to thrive as HFT, or in order to win the competition, you need to estimate value of things better than everybody else. So that means you need to come up with certain pricing, which is hopefully better than competitors' pricing. You need to react to changes fast. You want to update your prices really fast, and maybe take some action like really fast. This is important. And this is important because of the fact that if you're not the first one to take some action on obvious things to do, like just taking some offers, then your competitors might do it, and so you're losing some money against in favor of your because of your competitors. And third point is use resources efficiently. So I didn't cover much that point in this lecture, but I think there was some rate limits. And rate limits means that you can't send more, let's say, orders, or you can't send certain like API requests to the exchange more than, let's say, X times per second or per minute. So you actually need to manage those rate limits quite efficiently. Yeah, and in a worst case scenario, we will basically be out of rate limits. So you used up every possible order on the exchange, and when price changes, then you're unable to react to the price change because you already used up all rate limits. And fourth point means basically be creative. That's, I would say, like alpha research. So that basically you want to find some signal that is not found by others like extensively. And through that signal, you maybe can make some profits on average. So that'll be it. So thank you very much for your attention. And yeah, you can learn more about us on Vincent. I think it's Vincent.co, or is it com? It's co. Yeah. So it's without M. I'm open to any questions. Yep.
As a crypto market maker, how do you hedge your directional risk? Do you use perpetuals or?
Yeah. So for example, if you buy lots of spots and you want to hedge your risk, then you want to enter a short position on the perpetuals market.
So just perpetuals?
Yeah. So in that case, it could be perpetuals. Also, it could be options. But options market in cryptocurrencies is currently not that liquid. And it's more complex to hedge with options, but yeah, it also can be valid to hedge your position with some options. Mm-hmm. Yep.
Generally speaking, how volatile is liquidity? Like, do I expect day from day a big difference? Like today it's very liquid, tomorrow it's a very still market, no transactions.
It can be the case. So imagine that there is a new coin listed because there was investors heavily invested in some project. It's successful, and they want to monetize. They share through like ICO, which is initial coin offering, and in that case, there was lots of volume and lots of liquidity provided in the first days, first weeks, maybe first months of the coin existence. But if the project behind this cryptocurrency turns out to be shitty, then liquidity typically drops. And in some extreme cases, if the project was either like fake or it was a scam, and for example it was listed on Binance for some reason, then such coins can be delisted. Yeah. So you're first. Mm-hmm. In stocks, you're forbidden, like 100% forbidden to do market manipulation. And the easy example is that, there was like pump and dump, which was heavily exploited, like, very at the beginning. And pump and dump was a very easy way to make money because you were, buying a lot very quickly, you were pumping the price really fast. And afterwards, you were selling very slowly. And the average price of buying was smaller than average price of selling. And you were able to make some money, through this pump and dump. It's quite common on some, on some coins, pump and dump can occur. But, everything is, maybe not everything, but many things are anonymized. Then, sometimes it can happen, and you have to also take into consideration that some market manipulation can happen. Yep.
Taking commodities like cryptocurrency, for example, which are typically traded on multiple different platforms, do you feel there is still a potential for arbitrage that it's feasible to earn money that way, given the fees on trading?
Yeah, it's actually very difficult because the arbitrage is pretty much automated. So so it's difficult to execute those arbitrages. At the beginning, it was very easy. So not sure if you've heard about like FTX. Okay, so in FTX, at the beginnings of FTX, like Sam Bankman was executing lots of arbitrages, and he was seeing different prices in, let's say, on exchange called Binance and a price in South Korea. And he was executing that arbitrage, but the challenge was that he couldn't bought BTC trade like some cryptocurrency directly in South Korea. So he was, I think it's like one of the books. I think Flash Boys by Michael Lewis. It was he said that he was like paying some other people to trade that Bitcoin. So, for example, he was buying on Binance and selling in South Korea through a counterparty. That was legal, but at some point, I think competition intensified, and people started to execute those sort of arbitrage like much more often. But now it's like rarely the case. Yep.
What's the fundamental reason between crypto futures and crypto spot prices? Why is there more liquidity in futures? Because everything is digital.
I think the simple reason is that in futures markets or perpetuals markets, you can provide some collateral and you're able to enter some position on some leverage. So imagine that like you pay 50K, or like you basically not pay, but you put 50K to the exchange so that you can enter 100K position. And on spot markets, to acquire a 100K position, you would need to actually buy for 100K. And on futures and perpetuals markets, you can like just put 50K and you enter like 100K position at leverage 2. If exchange allows for higher leverages, then you can post like even maybe like 20K, and you will be still able to enter that 100K position. So it's much more capital efficient, but it also needs to be taken with care because there are risks of being liquidated, and liquidations are pretty expensive. Okay, so if there are no questions, I'd like to thank you again and good luck on the competition.
Do you guys have anything to add, maybe? I'm just asking. Okay, so thank you all for coming. I hope to see you all on the panel discussion at 5 p.m. It's in the building 2 minutes away from here. And tomorrow morning at the opening ceremony. So registrations start at 11.